Welcome to Wealth Addicts, the show where we are here to teach you how to protect, grow, and leverage your wealth. I am here with Jason Franciosa because he called me today earlier and said, I have a conversation topic I want to have. We started having the conversation and I said this would be really good to have on the channel. Jason is going to join in and talk a little bit. He had a call today with an insurance agent regarding how to set up a permanent life insurance plan. It was a whole life plan where he could go bank on himself or create his own private banking system or a few other ways they've referred to it. But basically the idea is dumping large amounts of cash into a life insurance policy, buying as little death benefit as possible so you can get all the benefits of cash value life insurance, things like creditor protection, a death benefit, the ability to borrow against your money and have it earn in two places at one time where you get two returns on the same dollar. And so since this is kind of one of the primary assets we look at using in the base of your wealth pyramid, I think this is a perfect time to go through and discuss it. So Jason, welcome.
Thank you, Sam. Yeah, so just a quick background. I started getting interested in these policies about 3 years ago when I first heard about them. And when I first heard about them, I'm like, what is this? It sounds almost too good to be true. I mean, there's a lot of claims made and a lot of taglines and fancy financial terms thrown out with these policies by almost every major company that has them. I mean, they've been in business for a very long time, so they know it works. So I've actually worked with two separate companies that done up illustrations for a whole life insurance policy. And every time I looked at them, I always just never understood how this could be beneficial to me if I don't have access to my capital for, on some of the projections, 7, 8, 9+ years. So that was the reason I never moved forward with any of them. It just never made sense. Like, why would I do this? So then after getting to know you, Sam, and seeing that you were a proponent of these, I realized there had to be something to them that I was missing. Basically, we had a lot of conversations. I did a bunch of research, and you drew up a policy that was structured properly. And it made perfect sense because I had full access to my capital based on the conservative projections that we put forward within the first year, or a little bit over a year. It was 100% access. So then it makes perfect sense. Okay, well, I can leverage against this. I can leverage against it at a rate where I'm not losing money on the loan, and it's highly protected. But then the virus hit, and equities went to nothing. So this made a lot of sense to try and get into something like a indexed life insurance policy, and why we're writing one for myself right now. Because the markets are down, there's a lot of potential upside going forward over the next 12 months, which means that the rate of return that the policy will give me on an index-backed policy has the potential to be very great this year. Anyway, I had a conversation with somebody who I worked with about a year and a half or 2 years ago, and they were pitching a whole life policy to me. The same issue. I looked at it, I'm like, okay, well, I understand in 30 years from now, 40 years from now, all these big numbers and there's payouts and everything, but that's a lot of risk because I don't know what I'm going to look like. I don't know what the world's going to look like 30, 40 years from now. I want to have access to my money today to be able to invest it in things that I believe are going to be great investments. To be fair, I think that he had full intentions of providing me with the best policy that he could. I just don't think he ever had exposure or really had clients who thought about these policies as using them up front as a bank account in the short term. So I had a long conversation with him, went through a lot of his points that he was making, but they all came down to three essential constraints that you discussed as being the most important thing. So one is access to capital. The other is where's the cost of the policy? And then finally, what did the final returns look like in comparison to the policy that you drew up? And on all three, the index universal life that you drew up for me was just much, much more beneficial.
No, I agree. And so a lot of times what happens with those is sometimes we're not always comparing apples to apples even. And I know when you first called me, you said, well, why would anybody ever buy a whole life policy? And so we kind of walked back from that a little bit and said, well, there are pros and cons to it, and structure makes a big, big difference. And that's one of the things that I think is really key to understand is like how you structure it makes a big difference in, the three rules of how much liquidity do I have year one? When do I break even, have more cash in the policy than I put into it? And number three is what is like my 20-year IRR? What was the expense that it took me to get there? So if I compare my gross to my net, the difference is how much was lost to expenses. I want that number to be under a certain percentage. We usually say at least under 20% expense ratio. because that gives us the highest likelihood of this plan succeeding going forward. So the difference is just really, one is structure, is getting that in the first place, because you probably compared a average structure policy to what I would believe on our side is an excellent structure policy that's in the top 1%. And so I look forward. I know you mentioned going through some of the more technical sides of this to give more detail on how people can review and do this on their own.
Yep.
I love that you're helping make this available, because this is something that's been a passion of mine for a while. As I see so many people who are in my space, which is the entrepreneur, business owner, investor space, who do these, and it pulls them away from their core cause, which is going out and building and creating. Anytime you are investing money, you're putting money into an insurance policy or any other kind of investment, and it's pulling you away from pairing your capital with your time, where you're not able to make that highest ROI, which is investing in yourself and your business, we're doing it wrong. You need to be able to do those things in the right order. And that's a big kind of sticking point for me, is I see a lot of people who get talked into doing these things for the future, which future savings are important, but we want to make sure that along the way, we don't hinder ourselves by taking too much of an opportunity cost when there is a better way. If there weren't a better way, we'd talk about it. But if there is a better way, we want to make sure we know it, get that information out there, and use it to hold the industry accountable by making it more transparent overall, which is a goal I have that is easier said than done, but I appreciate your efforts you're making on making that happen.
Awesome. Well, thank you for everything you do, Sam. And yeah, be sure to check out other videos. We're going to go a lot more detail on this. Make sure you subscribe to the channel if you want to see any more of the videos, and like the video.